Hello. Today we're going to talk about sensitivity analysis in finance and how that can affect your risk and capital structure. All right, so now we've got the purpose of sensitivity analysis. What is sensitivity analysis? Well, that is a financial model used to determine how target variables are affected based on known input variables. The analysis, why a sensitivity analysis is conducted? Well, it's conducted to make forecasts in finance for a business based on historical and current data. That's such as sales, cost of goods sold, earnings before income and taxes. Method of data collection. That is the data collected using qualitative and quantitative methods. The qualitative, we'll get into that later on in the slide. The analysis is used in order to create a forecast of risk management within the company and how to build your capital structure around that. So now we're going to talk about qualitative data collection. Qualitative data uses a known set of numerical values such as sales revenue, cost of goods sold, administrative and operating costs. It's calculated, you use these numbers to calculate and find the percentage of your gross margin. That is calculated by subtracting your cost of goods sold from total revenue, then taking that gross profit and dividing by the revenues times 100. This gives you a percentage of your gross margin. Need to determine a company's key variables. Now, these will vary from company to company once you get more in depth as to the industry you're in, but two variables will always remain the same across all businesses: sales and your gross margin. Historical data provides a better picture of revenues and growth. So this means take anywhere from 5 to 10 years to determine what direction your company is headed to get and use this data to put it into your quantitative table to help to forecast your future growth and revenue for your company. Okay, so now we're going to get into the quantitative data collection. The purpose of the quantitative evaluation of that data is to figure out the uncertainty of your evaluation metric. The quantitative data uses numbers and figures that are known from your qualitative data research and the figures that you got from that. So you're going to want to calculate the output for a new input. So basically what you're going to do is you want to figure out what you need to put in order to forecast a certain percentage of growth later on. So to calculate this sensitivity, you're going to divide the percentage in change in the output variable by the percentage in change in the input variable. So these assumptions are things such as your percentage of sales, your percentage of gross margin, your percentage of cost of goods sold. So all these numbers can be put into your table to determine what your sensitivity analysis is giving you as far as future growth. So the financial numbers, those can be changed in order to test different results of your analysis and see if there's anything else that you need to change in order to get to where you want to be. Now we're going to talk about how we use all of that in order to build risk into your capital structure. We're going to start with your sensitivity analysis, which that provides a forecast to determine future risk for the company. So you can use those numbers to kind of figure out if you're moving up or if you're moving down. Moving up is always good, always better. Provides a snapshot of how much risk the company has. So you're going to kind of take a look and see, based on your equity to liability ratio, how much risk your company has, and this is going to help to determine whether or not you can attract more investors or to invest and manage your cash flows to invest in projects for future gains. In order to attract more investors, and build this into your capital structure, companies will use a form of less risky investments in order to pay back investors, such as government issued bonds, something that is a very low risk that they know that the company can make money on in order to guarantee paying back an investor. They'll also build in risk into their capital structure with a payback period. A payback period is a time limit set on when investors expect to be paid back and get a return on their investment. So in conclusion, we know the qualitative data is the known numerical values that we have set. We know how much we have in sales, we know how much we have in revenue, we know how much operating costs, etc., etc. Those percentages are then taken and put it into the quantitative data table to get a forecast in determining your sensitivity analysis and determining how much risk a company is taking on. That sensitivity analysis is then built into your capital structure in a number of different ways in order to see where you are with equity and liabilities, and as a way to attract more investors. Plus, you're going to use that to determine if you can invest in other capital areas for positive gains within the company. So all of that risk is going to be built in to your capital structure using the previously talked about methods, such as your low risk investments, time limits on payback periods, determining your equity versus liability ratios in your sensitivity analysis. Hopefully this was helpful for you today. Thank you. Have a nice day.